Thank you so much for joining us. Today we have a special workshop on tax planning strategy for small businesses and individuals. Welcome to be our honored guest. My name is Cindy Shao. I'm the president of the Asian American Chamber of Commerce. I would like just to briefly introduce and mention our board of directors. And we just have phenomenal board. And also, we definitely want to recognize our beloved sponsors who actually make the event possible. And just to briefly introduce our upcoming events, we will try to support the Asian restaurant in the region because they have been in the hardest heat. We want to promote more Asian restaurants. Welcome to participate and patron those restaurants in the month of June. And we offer this member showcase second Friday every month. We invite our members to present their business. And this is a part of our GovCon series. We have a special training program. Have an expert who will give the in-depth training. Next, actually, let's welcome our wonderful moderator and the speakers. And I'd like to invite Emilia Roth. She's the senior wealth advisor from Wilmington Trust. She will serve as the moderator for today's panel, and she will introduce our phenomenal panel. Lydia, mic to you. Thank you.
Yes, great. Thank you so much, Cindy, for having me today. And I look forward to hearing all the great input and comments from highly esteemed panel members today. I'm going to actually let them introduce themselves, starting off with Emilia. Go ahead, please.
Hi, everyone. My name is Emilia Maffo, Sabine, CPA financial advisor. I've been a CPA since 2007 and a financial advisor since 2015. Now, I was a federal auditor at October 2016. I decided to go into finance, and my focus and my area is tax planning strategies and how to use it to build wealth and protect your wealth. Okay, so today I'm located in Owens Mills, Maryland, but I operate in almost all 50 states. So I have licenses in almost 50 states to do what I do. How can you reach me? Okay, if you, after today's event, if you want to contact me, you can reach me on my cell phone, 410-971-0584, or by text. So hope we're going to have a very good day today. Take notes and let's talk. Thank you.
Great. Satya, please go ahead and introduce yourself.
Sure. Thank you, Lydia, and thank you everyone for attending this webinar. I'm Satya Yerva. I'm CPA partner with Chugg LLP. Chugg LLP is a full-service CPA and attorney firm having 6 locations in the US and more than 300 employees. As CPAs, our expertise is in taxes, bookkeeping, audits, financial planning, and everything that a business needs under the for the CPA and taxes. So that's what we do. And we basically serve in DMV area. Our office is in Reston. So you can reach out to us by visiting our website, chugg.com or chugg.net. And you can find our contact number and email IDs there. Thank you, Lydia.
Great. Ashleen, please go ahead.
Thank you, Lydia. Hi, everyone. My name is Ashleen Chahani.
I'm a CPA. I've been into tax and accounting for almost 9 years now. I've been with the Chugg firm for over a year now. So today we will talk about, tax planning and new tax laws. So please feel free to ask any questions. Thank you so much.
Great, thank you, Ashleen. And your microphone got a little bit quiet, so be sure and speak up. I'm not sure if everyone had a softening as well, but I want to make sure everyone hears all the good things you're going to say today. And I'm Lydia Wolf with Wilmington Trust. I'm a senior wealth advisor and client advisor. We are a fully owned subsidiary of M&T Bank, and I want to say I'm very flattered to be part of this panel of great and smart tax advisors. So today we're going to cover several topics to highlight some common tax issues, offer solutions, and prepare you for possible impact of the proposed tax changes. To start our panel discussion today, I'm going to hit on a topic that is, I think, on the minds of many business owners, really relating to financial enhancements that we've seen in the markets lately. So to kick off, Ashleen, would you mind and take this first topic for us and update the members on the status of the assistance programs and also touch on any potential new proposed changes?
Absolutely, Lydia. So, I'll talk about it in two phases. Number one, any assistance program that has been launched by the government. Primarily, three assistance programs are being going on. First is Paycheck Protection Program, but most of the businesses here today must have already received it, and now it's in the forgiveness stage. It was a program launched by government to cover the payroll costs so that basically the businesses can survive this pandemic. So, the forgiveness has already started with certain banks, and make sure you're following the rules, you're using it for the eligible payroll costs, utilities, rents, and all. The second thing that's actually going on is employee retention credit. It's basically a refundable credit against the payroll taxes, the social security tax that employers pay for their employees. Every business is eligible for 70% of the qualified wages they pay to an employee in up to $10,000 in a quarter. So technically, you are allowed a $7,000 credit for each employee in every quarter. So this is a very, very good program launched by the government. Make sure you're utilizing it. The only condition that you have to satisfy is that there has to be a 20% revenue reduction with whatever quarter you are applying this ERC for. And the third and the last program that has been launched by SBA back in March of 2021 is Restaurant Revitalization Fund. This is primarily for any restaurants, bars, and any food-related industry. Basically, government is giving up to $5 million per location, up to $5 million of grant to all these businesses. And it is calculated basically based on the difference of revenue of 2019 year and 2020 year. So if you have lost revenue in those 2 years, government will give you a grant equal to that difference. And you have up to 2 years from today to use those funds. And you can use it for anything, your payroll, rent, utilities, business loan payments, your supplier costs, your food and beverage costs. So it's a really good fund, and we would recommend you to please take advantage of these financial assistance programs. Second of all, I would like to jump on to the new tax proposal with this government change that has happened early this year, and what our President Biden is proposing for individuals, for businesses. I'm going to touch upon a few changes that can impact most of us or all of us. So at individual level, we are going to see a change in the income tax rate. The maximum rate was 37%. It is going up to 39.6%. Most of the changes are for high net worth individuals or higher income people. There's already wages are taxed. There's a social security tax that you pay on your wages. But now there's an additional social security tax that will be introduced on wages over 400,000. And also in 2021, the child tax credit, which we receive for a $2,000 per child, has been increased to $3,000 per child, and also an additional $600 for any child under 6. And this whole amount is refundable. Earlier, it was partly refundable and partly non-refundable. So literally, you wouldn't get the whole amount. But in 2021, if you are under the income limits, then you're entitled to potentially $3,600 per child. It's a temporary relief, and government is planning on making it a permanent change. Another major change that is going to happen is to tax the capital gains at ordinary tax rates. Presently, capital gains are taxed at a 20% rate, long-term capital gains. So now moving it to ordinary tax rates could potentially impact higher net income clients. At business level, one of the major changes we are looking at is changing the corporate income tax rate. Presently, it is 21% for C corporations, and it is moving up to 28%. And another change that's happening is that government is doubling the GILTI tax rate, which is basically a tax on earned by income on foreign subsidiaries of US companies. So presently it is 10.5%, it is being increased to 21%. So these are the major changes. You know, there are a lot of other changes too, but these are the major changes that are impacting, that will be impacting us. So please keep a lookout for them, talk to your tax advisors so that they can plan accordingly for you for the coming year. Thank you so much. Over to you, Lydia.
Thank you, Ashleen. That was very informative. So for the next topic, let's broaden the conversation a bit and let's include not only businesses, but also individuals. Since tax planning is in the news, and as you've just discussed, you know, there's a lot of things being proposed. It's on everyone's mind at the moment. Emilia, would you please start us off by discussing some advantageous tax strategies that are top of mind for your clients? And Emilia, you're on mute, darling. Please click your button. Thank you.
Thank you. Thank you, Lydia. Thank you, Ashleen, for the insight. So piggyback on what Ashleen just said, okay, there are a lot of changes that have been proposed, but we have a lot of good stuff right now. And many people are just jumping into the unknown and just letting go what we have at hand right now. So we always say a bird in hand is worth 1,000 in the bush. So let's talk about what we have right now. Now, Ashleen touched on a couple of them. For business owners, we have some credits and stuff like that going on right now. QBA, qualified business income deduction, okay, is giving you credits right now, and all those things. Now we have other stuff like the tax rate, highest tax bracket rate is 37, as Ashleen said. Now we have all these credits. I don't want to go because Satya will go into those things. All these credits available to us right now. I know the pandemic happened, but also there have been credits and some stuff that have been given up to us. I think, based on my professional experience, a lot of people have some discretionary income, some income hanging around somewhere. So now, when we want to apply this to financial planning using tax strategies, how do they go together? Now we have all these low-hanging fruits and all this money sitting somewhere. We can only put so much into our qualified plans. What happens to the rest? Where are we going to put the rest of the money we want to put away for the future without getting ourselves into the unknown, which is the tax rates in the future? And that is what I'm going to talk about today. So I'm just saying that please focus on what we have in hand and start looking into some unconventional ways of saving and building money. Okay, so now the extra money, if you put it in a capital gains vehicle, and we enter into the new era of the proposed taxes, which will be higher capital gains tax. So it means you're going to pay higher capital gains tax in the future. What about you take advantage of what is happening right now? Pay taxes on the money that you have or the free credits and just put it in a vehicle whereby it can grow tax deferred and withdrawn tax free. One of the vehicles will be Roth. Okay, Roth, unfortunately, you can only put so much. And there are also income limitations. So there's income restrictions. So most people, what they do, those with knowledge, they use high cash value life insurance, okay, to start. Okay, now that one, there's no limit. The limit is what you put upon yourself. But the qualification is you have to qualify for the life insurance policy and you should be willing to pay for the life insurance, okay? And I think I'll touch upon that again later on in the conversation. So if you are open-minded, you want to look into a holistic way of building something for the future, and that would be a high cash value life insurance. There are several types. We can't have time to go into all of that. So let's focus on what we have now and let's not drag into the unknown and all the uncertainty that hangs around us. Thank you so much, Lydia, for the opportunity to share.
Great. So Satya, would you also please highlight some strategies for planning that would be useful for small businesses?
Yeah, certainly, Lydia. And thank you, Emilia. That was really good insights for attendees. So to start with tax planning for small businesses, I believe I always say to clients that your tax planning starts with right structuring of the entity. How you structured your entity, whether you are a LLC or a partnership or a S corporation or C corporation. So any tax planning for the business, it starts with structuring of the entity. And I would want attendees to look into your structuring first and see if there is any potential changes that you can do. Certainly, for a small business, S corporation is certainly an advantageous structuring. And so if at all, if there are certain individuals who are still managing with LLC without electing it as corporation, certainly that is one of the choice to save some taxes. So that's one thing that I would like to suggest. And second one is if at all, if your business has operations in several states, then planning a multi-state taxation, that's also one important thing, because what we see among our clients most of the time is so even though they do business in several states, because of probably they don't know the compliance requirements, they ended up paying tax in one state only where they located, ignoring the tax requirements in other states. So so what I would suggest in those kind of situations is to look into your operations in various states. It's not necessarily that merely having operations you need to pay taxes in other states, but you need to have an access and you need to allocate your income. There are certain guidelines regarding that. So certainly that is one area that I'd like to suggest. And then I'm not sure how many of the attendees have businesses with research and development activities. But if at all, if we have research and development activities, this is mostly applicable for tech companies. Then R&D credit is one of the good credit that is available both for federal and at a state level. So certainly, I mean, so what we see among our clients is even though they incur some expenditure for R&D activities, but they don't take the credit as such. Again, this is because of lack of advice or something. But if any of the attendees has businesses with R&D activities, certainly that is one of the major credit that anyone can take. So these are few of it, and some other small things that you may consider is you can weigh the advantages and the disadvantages between cash and accrual basis of accounting. So some businesses, certainly cash basis of accounting is more suitable from tax point of view. Some businesses, it's accrual basis of accounting. And if the business exceeds certain revenue threshold, then certainly one has to follow accrual basis of accounting. I think the limit is $25 million. Till that point of time, you can choose between cash and accrual. So you can probably do some planning over there. And if the other tax planning thing is if at all, if business needs a vehicle, then instead of buying the vehicle on the business name, an individual name, I would suggest to buy the vehicle in the business name so that you can take the accelerated depreciation on the vehicle. So this is again, we get a lot of questions around this. There are certain criteria to get a full deduction and accelerated deduction. So you can certainly talk to your CPAs and take sessions on that. And for small businesses, considering hiring your family members as an employee and pay some payroll and process some payroll depending on the number of hours that they spend, and that would save some taxes for the business as well as the individual. And if at all, if you have a really good profits, then investment in real estate is also one of the option, so that you can take the depreciation on the property. And initially for first few years, most probably you may not need to pay any taxes because of the depreciation deduction that you get. So Lydia, these are kind of a broad level tax planning strategies for the small businesses. Certainly, I mean, if any questions are there, then we are here to answer.
Great. Thanks so much to both of you for that great insight. So for the next question, as business grows over time and the owners create personal wealth, what ideas can you share with the members to help them protect their assets? Emilia, would you start us off?
Yes, Lydia, thank you. And that is a very important area that most people overlook, because we get so busy. Building a business is not easy. So we get so busy building, like exerting our energy and everything. And most of the time, we lose sight of the fact that we have to protect what we are building. So I'll just talk about a few areas and go deeper into one area. Okay, probate court. People build and build and build, and they forget they have to protect. So no will, no trust, nothing. And I'll give three examples. We have Prince, the musician, passed on, and no such things. And his staff, even though he's passed on long ago, his staff is still in probate court. And Aretha Franklin also passed on. She was alive when this happened, and she also passed on, and her staff is in probate court. So, and another person, so many stories that we can talk about. So business owners, my fellow friends listening to us right now, please protect what you build, trust wills. Okay, and another thing too, of course, taxes, we just said, we talked about taxes, so I'm not going to go into that. Now, big area is our health as we go about our daily activities. Life could change within a split second. In the US, every 40 seconds, somebody is diagnosed with cancer, heart attack, and all those things, stroke. So we are busy, and the pressure on us building, we have to protect our baseline. So, and then now we are living longer. We pray that nothing happens so that we live long, and there's a cost to living long, and that's long-term care. Long-term care is a big deal. So we live long, and now God blesses us. We live and live and live, and we have to expand our assets, liquidate to take care of long-term care needs. And boom, everything is gone. What happens? So we have to liquidate everything we've built over our lifetime just to stay alive and have a decent lifestyle. So a very important aspect of financial planning is to have a long-term care in your portfolio so that it protects you in case we are blessed with long life, and also protect the assets that we build. Please, if you do not have any of those things in your portfolio, yes, this is the time to start a conversation, but we all want to live long, and we want to live long, right? And I don't know if I have time, but if I have time, I'll come back and give the two option areas where you can look at to have long-term care. But Lydia, I'll come back to you later, maybe at the overflow time.
Okay, great. Sadia, can you add some additional thoughts to this topic, please?
Yes, certainly, I agree with Emilia on living trust thing. So, a lot of families just ignore about this, but this is one of the important thing. Otherwise, there will be a lot of cost on the probate and then custody issues and all. So, living trust planning is one of the living trust, and estate planning is also one of the important things to consider by individuals, and especially someone has assets, properties, and other business interests and all. So, so I'd like to kind of echo with Emilia regarding the living trust for the families.
Great. Thanks so much to both of you for being so thorough on that. So one of the final requests I have from the panel for comments is to find out what each of you believe is really a key priority or takeaway regarding taxes and planning for 2021. I think, again, it's in the news headlines. I think a lot of people are panicked about what to do next. And so helping people prioritize and see where they should focus. I think let's leave them with some good, helpful hints before we open for questions. So Emilia, would you mind commenting first, please?
Yes, so the task concerns, I'll focus on my area and my colleagues to their area as well. It's Ashleen just talked about capital gains taxes being proposed to go up. Okay, so now, and I always say, we want to be good stewards of money. As we work so hard, we have to put some away. So the vehicles that we use to put money away is very important. Very, very important because they have tax consequences. Okay, so now you have the deferred account, and a small business, we're doing the SEP IRA and stuff like that. Great. But the extra money, where are we putting it? And Satya just suggested real estate. What else? What if you have more money? Where are you going to put it so that you don't have to pay the higher capital gains taxes when and whenever it becomes a law? So we have to look into all those things. And that is my area where I say, please pay attention. We work hard. We need to protect our money from taxes. We have to pay our fair share, but we don't have to pay unfair share because of lack of knowledge. We need to know that. Thank you.
Great, thanks so much. And Satya, would you like to go ahead and add to that of key topics, please?
Yes, certainly, Lydia. So for 2021, I know 2021 tax returns are due next year somewhere in April, May. But a lot of clients that we see, so they come to us towards the end of the year in November, December, or early January, asking for tax planning at that point of time. So when someone approaches towards the year end, so we don't have much time to do tax planning, right? So what we advise is we are in May now, and start planning now itself, and see what's your income levels in 2021 versus 2020, and see what are your estimated taxes are going to be, and explore the options to reduce some taxes. So there are a lot of options that are available, either contribution to 401k, SEP IRAs, and investments. So we can do certainly tax planning is one of the area that I would suggest to consider. And other than that, what I would suggest is to again go through your if it is a business, then entity structuring, whether you have proper structuring or not, or if you want to change your structure, and this is the right time. And probably by the new tax proposals we are expecting. So in that area, some options see plan ahead, because we know though it is not passed yet, but we know pretty much what is going to be the changes. So plan ahead with the changes. I think Ashleen is going to talk more about it, but I think these are the three areas that I would suggest to consider for 2021. Right?
Okay, great. Go ahead, Ashleen. And Ashleen, you're on mute.
I'm sorry.
Thank you.
Thank you, Lydia. So just to carry forward with what Satya was saying, right? So I'll be very specific. One, we know that corporate income tax is bound to increase to 28% from 21%. So the structuring, especially for corporations and LLCs, whether you are an S corporation or a C corporation, right now we know that an S corporation, they don't pay taxes, and it passes on to the owners, and the owners pay tax on that income. And for C corporations, they pay at the rate of 21% presently. So with this increase in tax rate, where are you going to be? Where are you going to fall? Please consult with your tax advisor, and there are certain election forms that needs to be done. So work on that and see what can save you more taxes. And secondly, the one that we mentioned before, that there's a capital gains tax rate would change. It used to be a flat rate of 20%, and it's going to fall under the ordinary tax rates, which would entirely depend on your income levels where you are. So if somebody is at a higher income level, they're bound to pay a 40%, 39.6% tax on any capital gain that can happen moving from next year. So, it's very important if there is any capital gain transaction that is going on that can happen between now and next year, it's very important to plan ahead and see what is best and what is tax advantageous for you. That's all. Thank you.
Great, thank you so much. And before we open up to questions, Emilia, we have a few minutes. Would you like to go back and just mention the other points that we held? Because I think we have a couple minutes to go ahead and do that before we open.
Thank you so much, Lydia. Thank you. And Ashley just mentioned a very important strategy to use right now. So if you have staff capital gains, it's going up to 40%, depending on your income, of course. So this is the time. And I will say that if you qualify, okay, this is a time to get a high cash value. There are several types, high cash value life insurance, to move your money into that. Okay, you move the money in there, and because it's inside life insurance is not taxable. 7702 tax code since 1913. Life insurance is not taxable. So you move in there, it grows, tax deferred, withdrawn tax free. So that would be the greatest way to avoid the high capital gains taxes. And there's no liquidity restriction. So that could be source of income for your business and for your family. Now, let's say somebody says, no, I don't need life insurance. By the way, the death benefit that you're paying for, whatever you're paying for gives you death benefit, and it doubles to be long-term care. So if you live long enough, now the death benefit will pay to you as long-term care if you have a long-term care need. So talking about having long-term care on your portfolio, that's a great way to have long-term care in your portfolio and also have a cash accumulation tool inside your portfolio that is going to grow tax deferred and withdraw tax free. Is there a cost? Of course, the cost pays for the life insurance. The death benefit doubles to be long-term care. So that's one way to go for long-term care, or you can also get a standalone long-term care. And that one is cash indemnity. You give cash and then it pays you whatever the benefit is. And if you don't use it, it pays out to you as cash or as the benefit to you. And there's a lot of great things out there. So fill your sub-IRA, the additional money, okay, non-qualified plan, Accrual, it's not a plan, but non-qualified sources of putting as much as possible, as much as taxes, money you can put away, can be held inside a high cash value life insurance. And that is what we specialize in most of the time. Thank you.
Okay, great, thank you. So now, Cindy, can you help us open up to questions from your members, please?
Oh, yes, please, if you have a question, you can just type in the chat room.
Okay, we'll give a minute or two to see if anyone comes up with any questions. And if not, one question I would have for the group, because I'm hearing this from some of my clients, is people talking about some of the changes with real estate. I think it goes back to the capital gains timing of selling homes and worrying that if you were planning to sell your home and retire in the next few years, having the concern over what the changes are that impact the timing. We've seen kind of a boom on housing sales recently. I think because of some of that, we've seen a lot more demand. But I know a few people have mentioned to me that they are concerned if they delay selling the house, what could be the impact based on some of the gains. Is there anyone that would want to address that really quickly? Is that just going to fall back into the situation where it changes from long-term gain to personal income, or are there any other components specifically to selling the residence that you might want to comment on?
I will take this, Lydia. So basically,
thank you.
So I would like to say two things about it. One, we don't know what is the proposal going to be, whether it's going to be passed or it is going to be changed. But yeah, presently whatever there in the news, capital gain tax is going to be tax rate, ordinary income tax rate. That's the news. But one consideration there is the important thing is the capital gains tax at individual tax rate is applicable if the capital gains is more than $1 million. So if it is less than $1 million, then it's a normal 20% tax rate. So that is one thing that anybody would want to kind of consider before taking any decision. And second, the effective date of the new proposal. So most probably this kind of changes would be at the prospective change only. So the date that is passed into the law, then probably next year would be the effective date of the change. But sometimes the law may be retrospective effect also. So if at all, if they say that, okay, this is with effective from April 2021 or so, then that is something that we need to consider. So so on summary, two things. One, the ordinary tax is applicable if the capital gains is more than $1 million. As per the proposal that is presently in circulating in the media. And second, the effective date. So these two things we need to consider.
That's great. And then one other thing that, again, I've been hearing a little bit about is people, and we haven't really touched on here, but people asking questions about gifting. Should they take advantage of trying to do some gifting, again, this year before some of the exclusions change? And not knowing, and I think with every administration, there's always the chance that things change again. So I think on the one hand, some clients say, well, if the exclusion drops, substantially, it might change again later. But anyone have some thoughts on gifting for this year versus waiting? And, feel free to step in. Ashleen, what about you? Would you like to take a stab at that question?
Yes, so definitely, a thing to consider there is that whether you have crossed your lifetime gift exemption or not, where you are at, that rate. If you do have transactions involving a lot of gifts, or you do foresee something, then definitely, you need to plan ahead, because the tax rate also would increase and the exclusion and the limits would go down. So it might impact in longer run. Definitely you need to see whether you are crossing that exemption amount or not.
I would like to add one more point,
Please.
As everybody knows that, Trump administration changed the gift tax exemption to $11 million, and then now the Biden tax proposal, they are changing it back to $2 million. So that's what in the proposal. But yeah, certainly, if it is $2 million, then tax would be going to be higher if at all the gift amount is more than $2 million. But again, we need to see the final regulations and then the effective date of the change. So accordingly, we need to plan. Yes.
Yes, I think the other thing that people ask about to that topic is, as we know, a lot of business owners, and I think Emilia mentioned this, are very busy running their business, and they're not always focusing on taking care of themselves and their needs. And I think one of the concerns I have for people is that if you don't start talking to people now, if you want to get something done by year end, it's going to be difficult with every month that goes by, because I think more and more people are catching on that they need to do the planning this year, and they need to take action, but they just haven't gotten around to it. So any recommendations? always thinking like last year, I think just with the change in administration, I know our firm got very, very busy all the way through December 31st trying to get some trust work done. And I think it's going to be the same this year, but I think it's going to be even more aggressive. So any advice for people about don't wait too long and don't procrastinate if you want to do something this year? Emilia, do you want to just speak to that for a moment?
Yes, I will. I will. And I was talking about big amounts here. But of course, if anybody is thinking of using life insurance as a strategy, life insurance is you are qualified based on your health, so you don't wait. Okay, so and then people that talk about big monies, this is the time to get everything done. Trust, if you have a lot of money that's above all these limits, irrevocable trust is a good thing. Okay, and then locking money up in all these vehicles, it kind of protects you from the taxes that we're talking about. So now you can have sound sleep, move as much money out of the tax system as possible into the trust, life insurance, high cash value, and then you have all complete peace of mind. And you can focus on building your business because you have this fallback protection from everything that you're going to set up. So if you think you qualify for irrevocable trust, please don't wait until the last minute. If you want to use other holistic approaches to building wealth, don't wait. Because if life insurance is one of them, you qualify based on your health. You don't wait, otherwise you don't get it.
No, I think that's correct, especially after the pandemic. I think a lot of people have learned that, nowhere, regardless of age, so I think once you've gone through COVID, hopefully that's the wake up call to people to get their insurance while they're healthy. So I see we do have a question that just came in, and the question is, does a SEP IRA have revenue income limits like the Roth IRA does?
So yeah, I'll take that on question, Lydia. So basically, it's not the income limit. So any self-employed individual, if they have the self-employment income, so the limit is 25% of the compensation. If they have W2, then 25% of the compensation, or $57,000, whichever is higher. Or if they don't have the W2, then it is 20% of the net business income, or $57,000. So these are the limits for SEP IRA contributions.
Great, thank you, Satya. And one question, I was just going to follow up with you that you mentioned about if it drops, and just going back to the exclusions for a second, going from 11 million to 2 million. I think sometimes people are confused about the fact that maybe if their net worth is $2 million today, they feel like, oh, I don't need to worry about this. But if you have a business that's, really quickly growing, there's, maybe it's something in a really high growth, niche. So if you really were planning out over that person's life, maybe it's going to be tenfold higher, over the period of time. What advice might you get in thinking and helping people just think and understand those kinds of things that, again, part of saving or capturing some of that exclusion, protects you from the future. So it's not just the threshold that you see today, it's the expected. Could you speak to that for a quick second?
Yeah, sure, Lydia. So I understand the question that you have just raised. So basically, even though that the exemption limit is $2 million, then if the business is kind of a growing, then certainly there will be a lot of hope. If at all tomorrow, if that is to be gifted, then certainly there will be huge tax implications on that. But at this point, unless someone has plans of doing it right now, at this point of time, I don't think any action is required from that point, because we never know. I mean, this exemption limit may change tomorrow. After 2-3 years or so, if at all, if this is changed back to original amount of 11 million or whatever it is, then certainly that is an advantageous for the business owner. So I think, if at all it is not necessary to do the transaction right now, I think it is better to wait.
Okay, great. Thanks for that. And we do have some questions coming in. So can you elaborate on the different company structures, advantages and disadvantages that you mentioned before between the different types of corporations and LLCs, I think they're referring to?
Ashley, you want to take this or?
You can go ahead.
Oh, sir. Okay, so so there are typically so just to give a brief idea, there are two kinds of entities, LLCs and INCs, incorporations, at a broader level. And then when it comes to taxes, then there are some selections that can be done. LLCs can be treated in 4 different ways. If it is a single member LLC, then it is a disregarded entity, and ordinary income tax rates, whatever the tax bracket that individual will fall into, that is applicable. If it is a 2-member LLC, then by default it is a partnership. So then you have to file a partnership tax return, and then again there is no tax at a partnership level, but the respective share of the profits will be reported in personal tax return and pay taxes. And then the third is S corporation election. For an LLC, you can elect S corporation, and S corporation, again, there is no need to pay tax at entity level. It will be pass through entity, and you will report that income in your individual tax return and pay taxes. And then 4th option is C corporation. You can elect a LLC as a C corporation also. And the major disadvantage of C corporation is double taxation. You have to pay tax at entity level, and again you have to pay tax when you take out the money as a dividend. So C corporations are recommended for a very specific situation. Just to give an example, if you are planning to go to investors to raise funds, then certainly I think a lot of investors prefer to be shareholders of C corporations. And then if you are planning to issue stock options to the employees, then C corporation is good. But otherwise, for small businesses, S corporation is more suitable. That's true if you have employees, then if you process the payroll, then certainly there is some tax advantage in terms of self-employment taxes. And a single member LLC and partnership, it's a kind of a depending. What we see mostly is if we invest in real estate, then certainly an LLC with partnership mode is okay, because you don't have employees and you don't withdraw any salaries there. If it is a kind of a restaurants, then also a kind of a partnership is a bit okay. So this is all about LLCs. And when it comes to INCs, incorporations, then there are 2 elections that are available. By default, it is a C corporation, but you can elect as S corporation. Again, same advantages of S corporation will still be there for INCs as well. And C corporations, except the taxation, I think there are some advantages. So pretty much these are typical entity types idea, but we need to look into the specific situation of each business and decide the correct entity type for them.
Great, thank you for that. So we do have another question for each of you about the CPAs and what languages they speak. So the question is, do you have CPAs that speak Chinese, Korean, or Vietnamese? But why don't you answer that question? And if there's any languages that are at your firm that aren't included, please let us know. Emilia, do you want to go first with that?
Yes, we have advisors, not CPAs. I happen to have a unique background. So we have advisors that speak Chinese, traditional Chinese, and the Cantonese Chinese, so the various variations. We have advisors that speak several Korean. We have diverse background. So it doesn't matter what anybody speaks or understands, we have an advisor to talk to them. Yes.
That's great. And Ashleen, what about you? And Satya, you want to cover for your firm?
So we have people who can speak Chinese. I'm not sure about Korean and Vietnamese. Satya, do you know? We do have a lot of people in our firm. We have about 500-600 people. But Satya has been here more, so he would know in detail. Definitely Chinese, yes.
Yeah. So in our Chuk CPA LLP, that is where we operate CPA business there. So we have almost more than 100 employees, and certainly, I mean, I need to look into it. Certainly, we have different, we have diversified employees for sure.
Yeah.
We know people speak Chinese and Spanish, certainly.
Right.
But Korean, I need to look into our team members list. But in our office in DMV area, it's none of us speak Korean or other language. Yeah.
Okay, great. And this next question looks like it's going to go to Emilia to explain the cash value of life insurance and other types of life insurance there are, and so the different components that you were just speaking of earlier.
Yes, when we talk about cash value life insurance, we have 4 types. We have whole life, which is whole life is kind of a little expensive, whole life policies, and the growth is fixed, the death benefit is fixed, and the loan rates are kind of higher, and you can only take loan, you can't take withdrawal. Okay, that's whole life. And then we have universal life. That is, the premiums are flexible, so you can up and down, whatever it is. And then we have variable universal life. Variable are mutual funds inside life insurance policies. So they grow, they rise and fall with the market. And then we have the latest variation of life insurance, which is index universal life. So if let's say, if variable were to marry whole life, their offspring will be index universal life. So it's a hybrid of the two. So it lets you grow the cash value, premiums net of expenses, grows up to a cap in the market, or some companies is on cap, depending on what the client wants. But whatever you grow, you are guaranteed. You earn it, you don't lose it. You got the insurance companies hold you at a minimum. For most companies, it's 0. And then you have the option to add a rider to make the death benefit if you don't need it. If your kids are older and you don't need life insurance, you're older because you are older, right? So you need long-term care, to add a rider to make the death benefit long-term care. And of course, all the money, and there's on cap. Sub-IRA is capped, how much you can put in there. This one is based on the cap you put on yourself. The maximum you can put in is based on the size of the death benefit. So most people, and we have a lot of clients that are using this to just for non-qualified plans, which is outside the sub-IRA and stuff like that, moving a lot of money into there. Pay taxes now, use all the tax benefits now, and move the money in there and let it grow tax deferred like yourself, and withdraw it tax-free because it's life insurance.
Great, thank you for that. So we're coming just up to the end of the hour, and I don't see any more questions, so I think we're about ready to wrap up. Any final comments anyone wants to make before we end the call?
Thank you, Lady, and thank you, attendees, and thank you, AACC, for arranging the webinar. Thank you.
Thank you everyone for attending, and we want to have a huge shout out to Satya, Chuk, and sponsoring this event so more people can benefit. We record this session and we'll upload on Chamber YouTube channel and then share with the bigger membership on our distribution list. Again, thank you so much, Lydia. Wonderful job moderating the panel. And everyone just benefit so much, learn a lot. Thank you, everyone. So we can end the session here now.
Thank you. Thank you.
Thanks, everybody. Great job. I enjoyed it. Take care.
Thank you. Bye.